Indian rupee hit an all-time low on Friday, dropping 85.8 against the US dollar.
Yeah, all of this is expected. Everyone who's watching it, and I know, we flash it in red, we put that headline out, that is our job. But this is all expected after what the Federal Reserve is doing.
The Indian rupee has fallen an all-time low against the US dollar. The historic fall has everyone asking the same question. What is the reason for this historic fall of the Indian rupee? In this video, I'll take you through the four biggest reasons or the four major reasons for the historic fall of the Indian rupee. Second, I'll take you through the advantages and disadvantages of this decline. Yes, you heard it right. There are certain advantages also of this decline in the value of. Third, I'll tell you that how it directly impacts your life, how this decline in the rupee impacts our lives. And fourth and final, I'll tell you who exactly is responsible for this decline. Like, is it the government? Is it the policymakers? Who exactly is responsible for this decline in the value of the rupee? This is a story that affects every Indian. Stay with me till the end. You'll leave with answers that really matter. So let's dive in. But before we move further into our video to understand what is happening with the Indian rupee, we should know certain things or certain basic things about a currency and how it is valued. What is exchange rate? We should know these basics so that we could understand the basic reasons for what exactly is happening with the Indian rupee. Let's take a step back in time before the World War II. Back then, we were not using fiat currency as we use it today. We were using representative money. And what is a representative money? Like, every money or every currency was tied or pegged to a commodity, a tangible commodity like the gold. This type of currency system where every note and every coin was tied or pegged toward gold was known as the gold standard. This system was known as the gold standard. So basically, in the gold standard, what was happening was that every country had currencies which were tied to gold. So the amount of currency or the value of currency a country had was dependent on the value of gold that the country had. So clearly this system had limitations, and this became pretty glaring at the time of World War I. Why? Because the gold standard left no flexibility. New money can only be issued if there were more gold, tangible gold, I mean the commodity tied to these currencies, were discovered. And during a crisis like the World War I, that wasn't just enough. They wanted money, the countries wanted money, but they cannot produce money by the gold standard because you have to have gold equal in value to the amount of currencies you have. So if you do not have gold, you could not produce the currencies, or you cannot print the currencies as countries today do. So many countries made this tough decision and they abandoned the gold standard completely after World War I. And this marked the beginning of the fiat money. So countries started to print money freely. Unlike the representative money, the fiat money's value was not tied to a commodity like the gold. Its value was determined by the economic principle of supply and demand. The money that we use today is the fiat money, and its value is determined by the principle of supply and demand. The more the demand of a currency is, the more is its value. And the less its demand is, the less is its value. This system of the fiat money has its own advantages because it gives the governments the flexibility to print money freely during the times of crisis, like it happened during COVID-19 or any war situation. But here's the trade-off. When the governments print money or the currency during tough times like the COVID-19 or war times, then the supply of the currency increases and hence its value decreases. Its value depreciates. That's why most governments avoid excessive printing of currencies because it leads to depreciation of the currency. However, during crises like the war and the pandemic, governments do not have a choice. They need to print money to provide the stimulus packages, to support the citizens because the economy is not functioning well. Hence, they are left with no choice but to print the money. But yes, it depreciates the value of the currency because the supply increases. And this is somewhat related to the Indian rupee, where it is facing its own challenges after the COVID-19. Before that also, but after COVID-19, the depreciation has risen a a lot. Now that we have known what exactly a currency is and what kind of currency, like the fiat currency that we are using today, we should also try to understand how exactly do we have this currency valuation. So there's this crucial method that we use, which is called the exchange rate. And yes, some of us might know what an exchange rate is, but for those who do not know, I'll just quickly go through what exchange rate is and how it is used to do the currency valuation. So simply put, an exchange rate is the rate at which one currency can be exchanged for another currency. For example, let's say you're traveling to Europe and you want to exchange $1 for euros. Then the exchange rate is the thing that determines how many euros you will get for your $1. Currently in December of 2024, the exchange rate for US dollar to Indian rupee is somewhere around 85. So that means for $1 you would get 85 Indian rupees. Here is something important to remember. The exchange rate, or when we talk about exchange rates, they are always relative in nature. Like, we cannot just say that the exchange rate of Indian rupee is 85. We need to mention that the exchange rate of Indian rupees in relation to USD or the US dollar is 85. And now these exchange rates are a key or crucial way to determine if whether a currency is appreciating or depreciating with time. For example, let's say in 2022, the exchange rate for INR, I mean Indian rupees, to US dollar was 70. This is just an example, guys. So that means 70 Indian rupees could get you $1. Now, if the exchange rate changes to 75, it means you'll need more Indian rupees to get the same $1. In this case, we say the Indian rupees has depreciated in value because now you need more Indian rupees to get the same US dollar. So the value of the Indian rupee has depreciated. Now that we understand currency evaluation, and exchange rates, and all these basic terms, we should now move further to the main topic of this video, the four big reasons or the major reasons for the record fall of the Indian rupee in 2024. To discuss the first reason, have you ever heard people say, or governments say, or political leaders say that how crucial it is the foreign investments for India? We often talk about how these foreign investments fuel the economic growth in the country, increase the number of jobs in the country, and make new infrastructure in the country. But have you thought what happens when these foreign investors start pulling their money off from our country or any country, for example? That is what exactly is happening with India. The foreign investors or the foreign investments that we had, they have started taking their money off from India. Let's break it down further to understand what exactly is happening here. So the foreign investors or the foreign institutional investors, as we call them, FIIs, they invest in stocks, bonds, and other assets in India. In that very thing, they need to convert their foreign currencies into the Indian rupee. The foreign investors have to buy Indian rupees to buy these Indian stocks and bonds or any other assets they are investing in. So this increases the demand for the Indian rupee and hence its value appreciates. But here's the flip side. When these foreign investors lose confidence, maybe because of less favorable interest rates, weaker economic outlook of India, or maybe some political uncertainties, or they take their money off the system. So they just sell their stocks and bonds. They cash out their holdings in the Indian rupees and again convert them to their foreign currency holdings. So this now what happens increases the supply of the Indian rupee and hence its value depreciates. And this is not just a theory, it is happening right now. And over the past few months, foreign investors have taken off their money from the system. They have just sold their stocks and bonds in the Indian rupees, which has created a depreciation for the Indian rupee. In fact, in October 2024, foreign investors pulled out 1.14 lakh crores rupees, and in November, the net outflow of the foreign investors was rupees 45,974 crores. So the next time you hear about foreign investments, remember how closely they are tied to the strength of our currency, the Indian rupee. Now you might be wondering that why are these foreign investors pulling out their money from the Indian system? So there are some major reasons, and the reason number one would be the rising geopolitical tension. The world currently is grappling with a number of tensions or rifts going on, like for example the US China trade war, the Russia Ukraine war, the Israel Iran conflict. All these are the geopolitical tensions that are there in the world, across the world, and these have given the investors some sort of nightmare that their money can be, drowned by these conflicts, by these geopolitical tensions, because these are uncertainties in the world now. So it might happen that there are new policies which are not conducive to the investors, and hence they resort to safe havens. They do not want to stick with a developing country like India, where there can be uncertainties, where it is not so much stable economically, where it is not backed by, a reserve currency like the US has. So that's why they're pulling out their money from India and investing that money in the US dollar. I mean, compared to India, you can say that the US is a safer haven for investors. And in these times of uncertainties, politically, economically, I mean, all these tensions going over, as we discussed, it is better to be invested in a safer country like the USA than in India. And just for those who do not know, the US dollar reserve currency means that most of the trade globally happens in US dollar. So the US dollar is the common currency for the trades happening all over the world, and hence this is called as the reserve currency of the world, and hence its demand is always high because most of these trades are happening in US dollar. It is not the same with the Indian rupee. Indian rupee is not the common currency for trading across the world. So hence investors of course will resort to a safer US dollar as compared to the Indian rupee. So hence they are pulling out their money. Reason number two for the foreign investors pulling out their money would be the loosening confidence of investors in India, like the weak confidence of investors on these foreign investors in India. So this is actually due to a number of reasons. So we have witnessed slower than expected the GDP growth or the aggregate growth of the country, and there are some policy and political uncertainties that have been witnessed. There have been other things like corruption, and uh, the government has not been quite stable as it was earlier. So all these things have loosened the investors' confidence in India, foreign investors' confidence in India. And the first response to this loosened confidence in India is to pull out their money. Hence, the foreign investors have pulled out their money from the Indian system, from the Indian stocks and bonds and assets, and this has depreciated the Indian rupee. There is also this reason of the US government increasing their interest rates. Recently, we have seen interest rates rising in the US. The government is giving much higher interest rates to the investors. But recently, we have also seen rate cuts happening, but still, the rates are quite attractive for the investors. Hence, these investors have resorted to US dollars, investments in US dollars in the US, and took out their money from India. So, all these things together, like the geopolitical tensions, the rising interest rates in the USA, or the loosened or weakened confidence of investors in the Indian system or the Indian country as a whole, have led to a massive outflow of foreign funds from the Indian subcontinent. And as we discussed earlier, this outflow directly impacts the value of the Indian rupee. Okay, now let's shift our focus to the second big reason or the major reason for the depreciating value of the Indian rupee. And this second reason is the persistent or the continuous trade deficits that India is facing. For those who do not know, trade deficit happens, or we say that a country is having trade deficit when it imports more than it exports. India has faced minimal trade deficits starting the 1950s once we got our independence, but starting 2000, this value of the trade deficit has further intensified. So, this obviously means that India is spending more in buying goods and services imported from other countries than it is earning from selling goods and services or exporting goods and services to other countries globally. And here's the kicker, most of these imports happen in the US dollar. So guess what we have to buy US dollar for an imports. This increases the demand for the US dollar and increases its value, and we are buying US dollar, selling our Indian rupee, so that increases the supply of the Indian rupee and it depreciates the demand of the Indian rupee and hence its value. This has been a persistent issue for India. As you can see in this graph, you see that we are having trade deficits starting 2015. So this is a persistent thing that or an issue that India is facing. While you would say or you can say that trade deficits are common for developing countries or developing economies, this is something that puts pressure on their currencies, and the same goes with the Indian rupee. Our trade deficit, the persistent trade deficit, has put tremendous pressure on the Indian rupee, depreciating its value. It is not just about numbers, it is also about some of the external factors. Like, let's say we consider the Eurozone crisis. Now let's discuss about the third major reason for the depreciation in the Indian rupee, which is inflation. We know, and you would say that inflation is a common phenomena in every country. Every country faces inflation. But the problem arises when your relative inflation, I mean the inflation that you have in relation to your trading partners, the countries with which you trade, is high. And this is the case with India, especially in respect to or in relation to USA, we have a lot higher inflation. And this has caused the rupee to decline as compared to the US dollar. So, how does this inflation impact? Here's the deal. So, higher relative inflation in India means that prices in India will increase at a much faster pace than it increases in the USA. That means that you will need more Indian rupees to buy the same item than the US dollar you will need to buy the same item in USA. Let's break it down further with an example. Let us take the example of an item like a t-shirt. Imagine 1 US dollar equals rupees 75 today. This is just an example. So imagine 1 US dollar today equals rupees 75, and you're buying a t-shirt for 750 rupees in India or $10 in the USA, because 750 in India would translate to $10 in the USA. Now, let's say a year passes and India faces 10% inflation, while the USA experiences only 2% inflation, a lesser relative inflation. So, USA has a lesser relative inflation than India. India has 10%, while the USA only witnessed 2% of inflation. In India, the t-shirt price goes up to rupees 825. In the USA, the price rises slightly to $10.20. For the Indian t-shirt to remain globally competitive, the rupee must depreciate to around 82.50 per USD. This way, the price in dollars stays comparable, because now when the Indian rupee depreciates to 82.50 per US dollar, the price of the t-shirt in USA remains at $10, and while in India it is at rupees 825. And trust me, this depreciation has a chain reaction. This depreciation reduces the confidence of foreign investors in the Indian rupees, and it further weakens the Indian rupees. We should also talk about crude oil imports. Although we have talked about the trade deficit, how we import more and export less, but crude oil especially deserves a special mention. We import a lot of crude oil. In fact, 80% of our oil needed in the country is imported. That is right. We are heavily dependent on oil, and above 80% is imported. Check this graph. The blue line depicts our crude oil imports over the last 20 plus years since 2000. See how our imports of oil has risen over time. So it started with, if you see, 74.09 billion US dollar, sorry, in million metric tons. So it started with 74.09 million metric tons in 2000 and 2001, and currently it is standing at 232.7 million metric tons in 2022-23. So it has seen a dramatic rise in the last 20-24 years. And when it comes to the global oil demand, like the country which imports or which needs oil the most, India is only next to China. In fact, by 2024-25, India is expected to surpass China and account for a whopping 25% of the global oil demand. Yes, we would be accountable for 25% of the global oil demand. So I think we need to just digress from this dependence on oil and convert ourselves into a country which is not that oil dependent. We should be using more of renewable energy and other sources of energy so that we could reduce this import of oil, and hence the trade deficit that we are having can also be reduced, which can further strengthen our currency rather than weakening it. So currently this heavy demand for oil in India makes us vulnerable to the price fluctuations in oil that happens globally. But how does this issue with the crude oil import impacts the value of the rupee? Let's break it down. So here's the thing. When the global crude oil price rises, it increases the cost of importing oil for India. Now, since oil is traded in US dollars, India has to buy more of these US dollars to pay for these imports of oil. And as you can see again, this increases the demand for the US dollar against the Indian rupee, making it stronger as compared to the Indian rupee, and the value of the Indian rupee again depreciates. But that's not all. Hold on, that's not all. Increased oil prices also mean higher inflation in the country, in India. Since oil is a critical component of transportation and industries, its rise or its price rise results in price rise in transportation and the goods that we use from or produced from these industries. And as the crude oil imports grow, it further deepens or intensifies the trade deficit that we are having, because it further increases the imports that India is doing. This chain reaction has been a long-standing challenge for India, and it can only be reduced or eradicated only when we digress our reliance on oil for our energy needs. We should think of using other modes of energy. Now that we have talked about the record fall of the Indian rupee, it's time for actually talk about what it actually means for us. So let's start with the positives. Yes, there are few positives that we should discuss here. As we discussed earlier, that there are advantages and disadvantages. So we should also talk about the advantages of the fall of the Indian rupee. First thing first, the weaker rupee gives a boost to the Indian exports. Yes, Indian goods and services become more affordable for our trading partners in the global market. For example, our IT and software industry, or the IT and IT services industry, they benefit a lot from the depreciating rupee value, because now they can actually earn a lot from the much stronger US dollar or the foreign currencies. And these services, like the IT and IT services, for example, have their exports much affordable to our trading partners. Secondly, it is a great news for Indians living abroad who are sending money home as remittances. A weaker rupee means their remittances are worth more, and that extra money can be used to support families and the regional economies in India. But of course, it's not all good news. There are, of course, negatives which unfortunately affects most of us. First is the inflation, the issue of inflation, which rises by the weaker rupee. So with inflation, we have to pay more for the imports, for minerals, to crude oil, to shoes, to clothing, which in turn impacts the prices of these goods and services in the home domestic market. So we as a customer in India have to pay more for these imported products. Second is the Indian companies with foreign debts. They face the trouble. They now have to pay their foreign debts with more rupees, which in turn strains their balance sheets and also reduces their capability to invest in the growth of the company. A falling rupee can also affect the foreign investors' sentiments. They can lose the confidence in the Indian economy. A weaker currency often signals instability, prompting the investors to pull out their money from India. And this can reduce the foreign direct investment, which is actually critical to the growth of the Indian economy. This combination of inflation, increasing value of the foreign loans of Indian companies, and the reduced confidence of foreign investors in the Indian economy actually weakens our economy. It is kind of a mixed bag of negatives and positives, but of course, the negatives have a much broader impact. Now, let's address the pressing question of actually who is responsible for this record fall of the rupee. This is vital to understand that this is not about pointing fingers at one entity. The responsibility lies with all of us, the government, the businesses, the policymakers, and even the citizens to understand. To pay for these imports, we need to buy more US dollars, which actually increases the demand for the US dollar and weakens the Indian rupee. So, we are importing products and goods globally, and we need to buy these foreign currencies, majorly US dollar, because US dollar is a reserve currency. So their demand increases, these foreign currencies and US dollar demand increases, whereas the value of the Indian rupee depreciates because we are selling the Indian rupee to buy these foreign currencies. So the rupee demand decreases, whereas the foreign currencies and the US dollar demand increases, appreciating the value. To counter this, we need strong domestic industries to reduce our reliance on imports, especially in the critical sectors like energy. At the same time, India's IT services export is already world class, and we are contributing almost 60% of the global IT services needs. So we need to further strengthen this. So this is one strength which we must capitalize further because it will counterbalance our trade deficits. Policies also need to focus on enabling MSMEs, the small and medium industries in India. These enterprises, these small and medium enterprises, are actually the backbone of the Indian economy, and they provide large number of jobs to the young population of India. Remember, young population is a strength that India needs to capitalize, and we need jobs and education for these young population to prosper. Unlike the countries like Japan and China, which actually face aging population, India has a demographic benefit with its young workforce. However, as we said, this potential can only be capitalized to its full potential if we provide this young population with jobs and education. So we need a thriving ecosystem of small businesses, medium businesses, large businesses and startups to give jobs to this young population in India. Strong regulations must be paired with ease of doing business to encourage entrepreneurship and growth in the country. I don't know, but simplifying the complex policies like the GST and preventing ourselves from these hard measures like the demonetization can actually help the small, medium, and all size of businesses to thrive in India. The bottom line is that we are all part of the same story. With the right mix of policy changes, industrial growth, innovation, investments in the research and development, education for all, we can have a stronger rupee and also uh, have a good economic growth for India. Okay, thank you. And if you found this explanation helpful, do remember to like and subscribe this channel and also hit the bell icon because it will help me to produce more quality and data backed content in the economy, geopolitical, and personal finance space. Thanks.